Welcome to the Deep Dive, where we take the most complex financial stories and, well, we strip them down to what really matters, giving you that shortcut to being genuinely informed.
And today, we are wading into a story that just perfectly captures the chaos and the opportunity of late 2025.
We are talking about First Majestic Silver Corp, ticker AG.
This company is just such a fascinating paradox. I mean, you almost couldn't make it up. On one hand, you have this incredible operational success story.
Right.
They just posted a Q3 2025 revenue of $285.1 million. That's a 95% jump year over year. And they hit their highest production ever, 7.7 million silver equivalent ounces. They're set up perfectly to ride this wave of silver prices breaking decade highs.
Okay, so that sounds like an open and shut case, an instant aggressive buy. So what on earth is the paradox? What's the but here that stops us from just calling this a runaway winner?
The but, the paradox, and honestly, the existential threat. It all comes down to where they operate. 100% Mexico. This soaring success is built right at the epicenter of this incredibly volatile U.S.-Mexico trade war. We're not talking about some vague risk. We're talking about the specific looming threat of a 25% tariff being fully enforced on all Mexican imports.
And that kind of margin hit, if it's applied,
Yep.
It would just be devastating.
It would turn a record quarter into a financial disaster, instantly.
Okay, so let's unpack this. This is a huge tension. Our mission today is to analyze First Majestic Silver, AG, trading right now at $15.23 a share using the latest data from late November 2025.
And the question is simple. Is this aggressive, so-called purist silver player the ultimate value buy to ride the silver supercycle?
Or is its total focus on Mexico making it a perfectly situated value trap? The whole thing really hinges on whether geopolitics or market fundamentals win out in the end.
Let's jump right in.
Part 1, Chapters 1 to 3. Business, Management, and Financials. Chapter 1, Business Understanding. So we have to start with the core identity of First Majestic. If you follow this space at all, you know them for one thing above all else. Purity. They market themselves as the purest silver producer in the senior mining space.
And that purity is, well, it's fundamental to how they're valued, frankly. Most of the big miners, the Pan Americans, the Barricks, they're diversified. Silver for them is often just a byproduct of gold or copper mining.
Sometimes making up, less than 30% of their revenue?
Exactly. But AG has always strategically focused on primary silver extraction. It makes them the default choice for investors who only want one thing: leverage to silver itself.
And their model is more than just, digging ore out of the ground. Let's talk about their evolved business model.
Right. So the basic model is what you'd expect. They acquire properties, they explore them, develop them, and then produce. And the output is usually door bars and concentrates that they then send off to third-party refiners.
But, and this is where it gets really interesting, they've become much more sophisticated?
Yes, you're talking about the First Mint, their vertical integration strategy.
This is what sets them apart.
It truly is unique among the senior miners. They are not just digging, they're selling directly to you and me. By operating their own minting facility, they can bypass the traditional refiners for a big chunk of their production.
And they sell finished bullion coins, ingots, collector's bars, straight to retail investors.
Right.
So why is that such an effective hedge for the business?
It gives them enormous flexibility and margin control. In times of high volatility, think back to the silver squeeze events a few years back, the price of physical metal, the actual coins and bars, can just skyrocket way above the spot price on the futures market.
Their paper price, yeah.
By running the mint, AG captures that spread, that premium, directly. They realize a higher price per ounce than their competitors who are, stuck selling their door at the spot price. It's a really effective operational cushion.
Okay, so let's talk about the big accelerator for 2025, the Gatos acquisition. This move massively boosted their production, but it also necessarily diluted that purity percentage a little bit by adding more polymetallic exposure.
That's the trade-off, exactly. The acquisition of Gatos Silver closed early in 2025, and it brought the Cerro Los Gatos mine into the fold. This immediately gave them the scale they needed and helped offset some of the cash drain they were experiencing elsewhere.
And the result was that record Q3 revenue, $285.1 million.
Yeah.
That staggering 95% year-over-year increase.
That's it. That's the Gatos effect right there.
But let's clarify that purity question. After you integrate a huge polymetallic mine like Los Gatos, where does the revenue mix actually stand now?
Well, even with that big influx of gold, lead, and zinc, The numbers confirm that silver sales still account for about 56% of that Q3 revenue.
So they're still over that key threshold.
Oh yeah, that keeps them firmly in the primary silver producer category. For context, like we said, a lot of their peers fall below 40%. The gold comes mainly from their other successful mines, Santa Elena and San Dimas, and the base metals are mostly flowing from the new Los Gatos asset. So they scaled up massively but managed to keep their identity.
Okay, let's ground this in the actual assets, the mines driving these numbers. We've got three crucial ones to talk about.
First, you have the bedrock asset, San Dimas in Durango, Mexico. This mine is their high-grade cornerstone. It's famous for being efficient, low cost. It's just the reliable cash machine. It produced 2.69 million silver equivalent ounces in Q3.
The steady hand.
The steady hand.
Yeah.
Then you have the new jewel from the acquisition, Cerro Los Gatos.
Right.
Cerro Los Gatos in Chihuahua, where AG holds a 70% interest, is really the key to the 2025 growth story. It's a newer, large-scale polymetallic mine, and it instantly provided the huge volume they needed to jump into that senior producer league.
And its successful integration is the main reason for that record performance we keep talking about.
Absolutely. And then finally, you have the strange one, Jarrett Canyon in Nevada.
In the USA?
In the USA. Jarrett Canyon is what we'd call the optionality asset. It's a gold mine, and it's currently in temporary suspension. Well, management was just bleeding cash there. The operating costs were way higher than expected. Grades were low. So they made the tough, but I think strategic, call to pause mining operations in 2023 and 2024.
And what are they doing there now?
Just exploration and drilling. They're trying to prove up higher grade reserves.
Yeah.
But the key value right now is that optionality. If they can successfully restart it, it provides crucial U.S. domicile production.
Yeah.
And given what we're about to discuss with the trade war.
That's incredibly valuable insurance.
Exactly.
And speaking of scale, AG is now officially a senior producer. That Q3 output of 7.7 million ounces puts them on a run rate of over 30 million ounces a year. That's a huge step up.
It's a game changer. I mean, compare them to a smaller competitor like Endeavor Silver, who did about 3 million ounces in the same quarter. AG is operating at more than double the scale now. They're in the elite tier.
So why do investors accept that crazy high PE multiple we'll get to later and choose AG over, say, the safer, more diversified majors? What is the core value proposition here?
It really is the ultimate high-risk, high-reward play. I think investors buy AG for three reasons. First, purity, which we've covered. Second, leverage. It's a high beta stock to the silver price, so you get more torque, more bang for your buck on the upside.
And third,
the Keith Neumeyer premium. You are buying into the founder's aggressive, very outspoken belief that silver is massively undervalued and is heading to triple digits. For a lot of people, AG is the philosophical trade in the silver space.
Okay, let's zoom out to the industry. We mentioned silver is hitting decade highs. What is driving this huge structural deficit?
The old story of silver just being a safe haven asset, poor man's gold, that's really secondary now. Silver is the essential green metal.
Yeah.
The structural deficit is immense, and it's being driven by technological demand that mining supply just cannot keep up with.
Let's drill down on the solar revolution, because that seems to be the biggest piece of this.
Photovoltaics is the single biggest tailwind. The move to higher efficiency solar cells, specifically technologies like TOPCon and heterojunction, they require way more silver paste per panel than the older designs.
How much more?
Sometimes 15 to 20% more. This tech leap means the demand projections are just staggering. Analysts are now projecting that photovoltaic demand alone could require somewhere between 300 to 400 million ounces annually by 2030.
Wait, hang on. 300 to 400 million ounces? The entire global mining output is only, 800, 900 million ounces? You're saying half of all the silver mined in 5 years could be going just to solar panels?
That's exactly what the data suggests. Yeah. And when you add in electrification EVs, 5G components, and the renewed investment demand because of inflation and all this geopolitical turmoil, you have a perfect storm on the supply-demand side.
Wow.
The compound annual growth rate for silver demand is expected to be 15.9% through 2030. The fundamentals for the commodity itself are undeniably explosive.
Okay, so that macro view is incredibly bullish. But let's bring it back and compare AG to its direct competitors. How does it stack up against Pan American Silver and Hecla Mining?
Pan American, or PAAS, is sort of the model of diversification. They operate across several countries, which makes them safer. But AG offers much higher torque because of that purity focus.
And Hecla Mining is the really interesting comparison given the risks we're talking about.
Hecla is the key comparison, yes, because Hecla is the U.S.-based player.
Which gives them a huge advantage in this particular climate.
Precisely. Hecla trades at a valuation premium, specifically because its U.S. domiciled production insulates it from that 25% tariff threat that is hanging over AG's head. Investors who want a safer way to play the silver rally often choose Hecla. They sacrifice some of AG's purity for that geopolitical safety. It's the clearest trade-off in the sector right now.
Let's talk more about that regulatory environment in Mexico, because AG is completely exposed there. We know the current administration has been, let's say, less than friendly to mining.
The environment has definitely tightened. The Mexican government has affirmed that no new open-pit concessions will be granted. And that has created, massive uncertainty for exploration companies.
But for an established player like AG, it's different, isn't it? It almost creates a moat.
It creates a very strong defensive moat. If the government isn't issuing new permits, then the value of AG's existing permitted long-life assets, San Dimas, Los Gatos, Santa Elena, it just skyrockets. They become these finite, precious resources in a restricted market. It insulates them from new domestic competition.
But the regulatory friction isn't just about permits. There's that relentless, lingering legal battle with the SAT, the Mexican Tax Authority.
Yes, that dispute centers on how taxes were calculated on the San Dimas Screaming Agreement, dating all the way back to 2010, 2014. It's this ongoing issue that just maintains a constant level of legal uncertainty over the company, even while they're hitting record production. We'll see in the financials how they're trying to mitigate the risk of a potential $200 million plus payout.
Okay, let's wrap up this chapter with their cost structure. All-in sustaining costs, the AISC, was $20.90 per silver equivalent ounce in Q3. That sounds pretty high. Why is it still seen as a positive?
It is elevated, historically. But context is everything here. First, the Gatos acquisition actually helped lower their consolidated costs a bit through economies of scale.
Yeah.
We saw a 1% decrease year over year.
Okay.
But second, and this is the important part, the operating leverage is massive.
Explain what that means for our listeners.
Okay, so if your cost to produce an ounce is, say, $21, and silver is trading at $30, your margin is $9. Simple. But if silver hits $50, your cost only goes up a little with inflation, but your margin jumps to $29.
Yeah.
That's more than triple the margin for a 66% price increase. That 21 AISC creates massive margin expansion potential in a $40 or $50 silver world, which is what management is betting on. The flip side, of course, is that if silver corrects to $25, they're barely profitable. It's a very high-stakes cost profile.
That really sets the scene. We understand the machine. Now let's look at who's steering the ship. Chapter 2. Management evaluation.
First Majestic Silver is, in so many ways, just an extension of its CEO and founder, Keith Neumeyer. He's the aggressive public face of the company. He's a known industry builder. He also founded First Quantum Minerals.
And his strategy has always been pretty clear.
Oh yeah, aggressive growth by acquisition, usually using the company's expensive stock as currency to do the deals.
Okay, his track record as a builder is clear, but let's look at crisis management. The Jarrett Canyon acquisition, that was not a success, at least not initially. How do we grade his handling of that specific operational failure?
The Jarrett Canyon deal was, you're right, undeniably a significant initial failure. It became a cash drag that really hampered the company's overall ROIC for years. However, I think management deserves credit for the ultimate crisis management decision.
Which was?
Suspending mining operations in 2023-2024. That was the tough but absolutely necessary call to make.
Okay, I have to challenge that a bit. If the initial acquisition was a clear mistake that required shutting down the mine just to stop the bleeding, why are we giving them credit for just stopping the bleeding? Shouldn't we focus on the initial bad decision to deploy the capital in the first place?
That's a fair critique. The initial mistake was definitely underestimating the costs and the complexity of that Nevada operation. But the pivot, the decision to stop, shows operational flexibility, which is so crucial in mining. A more rigid, maybe more prideful management team would have just kept sinking capital into a losing venture to save face.
Right.
Neumeyer cut the loss. He preserved their cash fortress and shifted the focus of Jarrett Canyon to high-return exploration instead. And that flexibility, that cash he preserved, proved instrumental in making sure they had the reserves to successfully pull off the Gatos acquisition later.
Okay, let's look at how they manage investor perceptions.
Yeah.
Q3 2025, they missed the EPS forecast. It was $0.07 versus an expected $1.11. How did they handle that narrative?
They handled it expertly. When the analysts started focusing on the operational hiccup that caused the miss, management immediately pivoted the conversation. They aggressively highlighted the record production numbers, the massive growing cash pile $568 million in the treasury.
Isn't that just classic IR spin, though? I mean, if they hadn't missed the forecast, they wouldn't have needed to pivot the narrative.
It is absolutely spin, but it's effective spin. They successfully diverted investor attention away from a quarterly fluctuation and back to the big macro story that people actually buy AG for in the first place.
The leverage to silver and the solid balance sheet.
Exactly. It shows a very skilled IR team that is focused on maintaining the stock's premium valuation by emphasizing that future potential over any immediate disappointment.
Okay, what about transparency and their legal stance on that big tax dispute? Taking it to international arbitration that's a pretty aggressive move.
It is extremely combative. They're pursuing international arbitration under the old NAFTA SMCA rules for the San Dimas tax issue, rather than looking for a quiet settlement.
And what does that signal?
It signals a management team that is willing to fight the Mexican government tooth and nail for shareholder value, even if it means years of legal uncertainty. They're basically saying, we will not be bullied, which, that appeals greatly to their retail pro-silver investor base, but it does keep the company in a constant legal spotlight.
Let's talk about the most critical capital allocation decision of 2025, the Gatos M&A.
The Gatos Silver acquisition was an all-stock deal. It required them to issue 2.55 AG shares for every Gatos share. So yes, it diluted existing shareholders. But the verdict is that it was a strategic masterstroke.
Why was it so smart?
They used their high multiple stock, their expensive paper, to acquire an immediately cash-flowing, low-cost asset that instantly gave them the scale they needed. It directly and successfully offset that long-standing operational drag from Jerritt Canyon and turned them into a senior producer overnight.
Right.
It was accretive to cash flow, which is, at the end of the day, the ultimate benchmark for a successful acquisition.
And what about future spending? They've guided $182 million in CapEx for 2025.
And that budget signals they are still in aggressive growth mode.
Yeah.
We need to break that down. $80 million of that is sustaining capital, just to maintain current operations.
Yeah, right.
But $102 million is expansionary capital. This is for critical drilling and development programs, mainly aimed at extending the mine life and finding higher grades at their cornerstone Mexican assets, like San Dimas and Santa Elena. It confirms their strategic focus is still squarely on Mexico.
Given that growth focus, I assume the return of capital through dividends is minimal.
Minimal is the word. The dividend is tiny. It's a variable token tied to quarterly revenues. It was around 0.5 cents per share for Q3, yielding about 0.15%.
So not an income play.
No, this is not an income stock. The dividend is just a symbolic gesture of profitability. You're buying AG purely for capital appreciation potential.
They did renew a share buyback program, canceling about 500,000 shares in Q2. Is that enough to counteract the dilution from the Gatos merger?
No, not even close. While buybacks are shareholder-friendly, the sheer volume of shares they had to issue for the Gatos deal just vastly outweighs the effect of that small buyback program.
Okay, let's wrap up management with return on invested capital, ROIC. Are all these huge investments actually generating real shareholder returns yet?
Historically, AG's ROIC has been mediocre. It's been volatile, often lagging the company's cost of capital. Q3 saw strong operating earnings of $99.1 million, which is great, but the overall ROIC still hovers in the mid-single digits.
So how is that justified?
The only way their past capital spending gets justified, in retrospect, is if the silver price stays sustainably above $40 an ounce. That's what would drive the huge margin expansion they need. Management is fundamentally betting that the macro environment will come in and validate their aggressive spending decisions.
Chapter 3, Financial Health. All right, we understand the strategy. Let's dive into the cold, hard numbers. The sheer size of this company is growing fast, with the market cap now somewhere between $4.5 and $5.1 billion.
And that valuation, as we've hinted, is already pricing in enormous future potential. Investors are paying a premium for the optionality of a silver spike, not just for the cash flow being generated today.
And the revenue growth in 2025 is just transformative. They're on track to smash $1 billion in annual revenue for the first time ever, up from $561 million in 2024.
This near doubling is the defining financial story of 2025 for them. It's that perfect combination of the new volume from Los Gatos and the very favorable realized silver price, which was around $39 an ounce in Q3. This is why the market is paying such close attention.
Okay, let's look at profitability. They reported mine operating earnings of $99.1 million on that $285 million in revenue. That implies a really healthy gross margin expansion of about 35%.
That gross margin shows they are successfully capturing the upside from the silver rally. But we have to keep coming back to the Achilles heel, that all-in sustaining cost of $20.90 per ounce. Because when you look at the whole income statement, the net margin is actually pretty thin. It's hovering between 12 and 14%.
Wait, hold on. If they're getting $39 and only spending $21 to produce it, why is the final net margin so thin? Where is the rest of that money going?
That's the key question. That 21 AISC only includes the mine-level sustaining costs. It does not include corporate G&A, the administrative expenses. It doesn't include exploration costs outside of sustaining CapEx, debt service, though their debt is low, or the massive tax burden, including all the legal fees for that SAT dispute.
Oh, okay.
Those expenses dramatically thin out the final net profit. And it means that if silver corrects back down to $25, those net profits just evaporate. The margin of safety is structurally very low.
But the real turnaround story here is free cash flow. Historically, this was often negative because of Jarrett Canyon and all the heavy investment.
This is maybe the single most important metric showing their operational success right now. Q3 2025 saw record free cash flow of $98.8 million. This signals a critical transition for the company. They're finally moving from being a cash consumer in that development phase to being a major cash generator. They're harvesting.
And that free cash flow is feeding directly into what you've called a fortress balance sheet.
Fortress is the right word. They operate with extremely low leverage. Their debt-to-equity ratio is about 0.09, which is exceptionally low for a major miner.
And that gives them safety.
Tremendous safety. They are not dependent on creditors if the commodity cycle turns against them. Liquidity is pristine, a current ratio of 3.4, record working capital of over $500 million.
And this huge liquidity, that $568 million cash buffer, that's their critical tool against that looming SAT tax dispute, right?
Precisely. If they lose that high-stakes legal battle and are forced to pay out the estimated liability, which is over $200 million, they can absorb that cost without even blinking. They won't have to issue distressed equity, take on debt, or stop their expansion plans. The balance sheet is the ultimate safety net for all the geopolitical and regulatory risks they face.
Okay, let's finally tackle the elephant in the room, valuation. We've talked about this purity premium, but let's be specific. How crazy is this PE ratio?
It is genuinely staggering. The trailing 12-month PE ratio is somewhere between 90 and 96.
96 times earnings. For a miner, that sounds like a pre-revenue tech stock, not a mature mining company. How is that sustainable in any fundamental model?
Well, you're right, it isn't sustainable based on current earnings, but it's seen as entirely justifiable based on future potential, at least in the mind of a silver fundamentalist. When you compare it to its peers, the disconnect is just so clear.
Right.
Pan American Silver trades at around 25 times PE. Hecla Mining, which trades at a premium for safety, is around 48 times. AG is at nearly double Hecla's multiple. This extreme premium reflects the retail conviction and the implied torque, or leverage, to a supercycle. Investors are paying 96x because they believe in a $100 silver scenario.
So if we look past the hype and use a discounted cash flow, a DCF model, to find the intrinsic value, what are the key assumptions that drive that valuation?
A DCF for a miner is always incredibly sensitive to the commodity price. Our model assumes a realized silver price of $35 an ounce long-term, maybe increasing to $45 as the deficit deepens. And crucially, it assumes they successfully mitigate the worst-case scenario with that 25% tariff.
And if they do that, what does the base value look like?
Based on those assumptions, the intrinsic value ranges between $13 and $15 per share. And since the stock is trading at $15.23 right now, it confirms the market has already priced in a lot of that bullish potential.
So it's fairly valued, slightly overvalued based on a conservative price forecast. What about the bull case, the $50 silver dream?
If silver sustains $50 or higher, that massive operating leverage from the 2108 AISC kicks in, and the DCF model can easily support a valuation of $18 to $23 per share.
So the stock is essentially trading like a leveraged call option on the price of silver.
That's the perfect way to describe it. But the critical sensitivity is that the price falls at $30 or worse, corrects, that 96x PE valuation completely breaks down, and the downside risk is severe.
That tension is really what makes this stock so compelling. Okay, let's move past the fundamentals and see what the market is actually thinking right now. Part 2, chapters 4 to 7. Market sentiment, ownership, risk, and final conclusion. Chapter 4. Market sentiment.
So we need to get a handle on how analysts and the technicals are reacting to this high-octane setup, and Wall Street consensus is cautious.
Cautious, but probably chasing the price up.
Exactly. The consensus is mostly a hold or a moderate buy. The average analyst price target is around $15.14. The fact that the stock is trading a bit above that at $15.23 tells you the market is currently ahead of the average analyst.
They're uncomfortable with that PE ratio.
They are. They're reluctant to raise targets aggressively until they see proof of multi-year price strength and, more importantly, some kind of resolution on the tariff threat.
We mentioned that Q3 earnings miss it, dropped 3%, and then immediately rallied 12%. What does price action like that signal to you?
That is the defining characteristic of a profoundly bullish, conviction-driven stock. It's that classic scenario where bad news is bought. The market actively ignored the operational disappointment and instead focused entirely on the unstoppable macro narrative. Record revenue, silver scarcity. It proves this is a macro trade, not an earnings trade.
Okay, let's get into the technicals. What are the moving averages telling us about the momentum?
The momentum right now is very strong. The stock is trading well above both its 50-day and 200-day moving averages. And even better, the 50-day is hovering above the 200-day, which confirms a recent golden cross.
And that's a powerful long-term bullish signal.
It is. It indicates that the positive momentum trend is really entrenched.
Okay, that's the long-term view. What about the immediate warning signs?
Here's where it gets really important for traders. The Relative Strength Index, the RSI, is extremely high. It's sitting at 89.7.
Whoa. Anything over 70 is overbought. Near 90 that's running red hot.
It's screaming that the stock is overheating. It suggests that a short-term pullback is highly probable as traders start to take profits. The market is just running very, very hot right now.
And what about the short sellers? Is there potential here for a short squeeze if silver really takes off?
The short interest is elevated. It's around 11–12% of the float, which is roughly 24 million shares short. Now, the days to cover is pretty low, about 1.25, but that sheer volume of short positions is essentially a barrel of dry powder.
So if silver breaks a key level,
if silver were to break a key psychological barrier, say $55 an ounce, that short base could trigger a rapid acceleration of the rally. It could easily propel the stock toward $20 as all those shorts rush to cover their positions. It adds immense torque.
And that potential for torque is what the high-risk money is paying for. Before we look at who exactly owns this stock, a quick reminder for you.
If you are finding this level of detail helpful in navigating the market, we really encourage you to join our community.
Like and subscribe to Stock Analytics AI.
And if you want to accelerate your knowledge and get ahead of the market moves, we have a concise pitch for you. For $4.99 Money Month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
We focus on actionable insights. Now let's get back to who is actually trading these shares. Chapter 5.
Ownership structure.
Understanding the ownership structure is so key to explaining AG's unique price behavior and that high valuation. Institutional ownership is around 55%, and it's dominated by large passive index funds and sector-specific ETFs.
And the most important institutional holder here has to be Van Eck, right?
That would be Van Eck Associates, yes.
Yeah.
The powerhouse behind the major mining ETFs like GDX for gold miners and SIJ for the junior silver miners. Van Eck holds about 43.5 million shares.
And the implication of that is critical. It is. By being a top holding in these main silver and mining ETFs, AG benefits from passive liquidity. So whenever retail or institutional money flows into those funds, which often happens just based on rising silver headlines, AG receives automatic passive buying pressure. It essentially outsources its liquidity generation to the ETF market.
So that helps explain why bad news is bought. The macro flow just pushes it higher regardless. What about insiders? Does CEO Keith Neumeyer have enough skin in the game?
Oh, absolutely.
Yeah.
Keith Neumeyer owns approximately 4.07 million shares. At current prices, that's a value well over $60 million. He is profoundly aligned with shareholders' interests in seeing the silver price go up.
Okay.
And while there has been some routine insider selling recently, probably for tax diversification, he remains one of the largest individual holders.
And finally, that retail concentration. This is what really drives the volatility, isn't it?
It drives the volatility and the valuation premium. AG is famous for having a high retail concentration compared to its peers. And retail investors, they tend to trade on sentiment, on the macro story, on that philosophical conviction about silver's future.
While the institutions are focused on the DCF models.
Exactly. The price is driven by this very visible tug-of-war where retail conviction often just overrides the fundamental valuation metrics, and that's what keeps that 96x PE multiple supported.
We've covered the business success, the management strategy, the financials, the bullish sentiment. We now arrive at the chapter that really defines the company's fate. Chapter 6, risk assessment.
We've saved the most critical chapter for last because the incredible operational success story is, in my view, entirely overshadowed by one major risk, the geopolitical threat. But first, let's quickly frame this with a SWOT analysis.
Okay, starting with internal strength.
Strengths. It's the pure play status. The unparalleled cash fortress, $568 million in cash, negligible debt, and those high-grade, stable assets like San Dimas providing consistent output.
And the internal weaknesses.
Weaknesses. That high-cost structure, the AISC near $21, which limits their margin of safety. Jarrett Canyon is currently just idle dead weight. And critically, that extreme valuation, the 90-plus PE, allows absolutely zero room for error.
External opportunities.
There's exploration upside from new programs. There's the potential for a silver price explosion, the $100 scenario where their operating leverage could just quadruple earnings, and of course, the potential restart of Jarrett Canyon, which would add that much-needed diversification into the U.S.
And finally, the external threats.
Threats. The hostility for Mexican mining laws, that no new concessions rule, the risk of having to pay that $200 million plus SAT tax demand, and the ongoing risk of future dilution from management's aggressive M&A playbook.
Okay, let's dedicate the rest of our time here to the single critical geopolitical threat that defines this stock, the 25% U.S. tariff. This is the ultimate binary risk.
It is the single biggest bear case argument, and we have to detail the mechanics. On February 1st, 2025, the U.S. administration signed orders imposing 25% tariffs on all imports from Mexico as part of this escalating trade war.
Okay.
The legal mechanism they're often using for this is Section 232 of U.S. trade law, which allows tariffs based on so-called national security concerns.
So how does that specific U.S. action become an existential threat for First Majestic?
Well, AG is 100% operational in Mexico. They mine the ore, they process it into silver door bars, and those bars must be exported, either to U.S. refiners or for their first mint operation. If a 25% tariff is fully enforced on the gross value of that silver, it would instantly wipe out their operating margins.
Okay, let's use the Q3 numbers to make this real. If the realized price was $39 and their cost was $21, their operating margin was $18 per ounce. If you slap a 25% tariff on that $39 price, that's what, roughly $9.75 per ounce.
Right, you've just cut that $18 margin in half.
And that's just the tariff. When you factor in all those other corporate costs we talked about that already shrink the net margin, losing half your gross margin means...
It means instant and massive unprofitability. The company would be burning cash immediately. It is an absolute critical life or death threat to their current business model.
So why isn't the stock trading at $5 if the threat is that severe? The market must be pricing in some kind of mitigation or an exemption. What's the current status on this?
The status is fluid and highly political. As of right now, in November 2025, the tariffs have been subject to a lot of suspensions and complex negotiations, mostly focused on things like agriculture and manufacturing. The silver market is currently pricing in the belief that AG will successfully navigate this, probably through a loophole.
Let's talk about that loophole, the historical exemption for precious metals.
The loophole rests on how the product is classified. Precious metals, like silver door bars, fall under specific tariff codes. Historically, these kinds of tariffs are aimed at protecting U.S. manufacturing and are applied to manufactured goods, not raw commodities or monetary assets like precious metals.
So the argument is that silver bullion should be treated more like a currency or a capital asset than a manufactured good.
Exactly. But, and this is a huge, but in a full-blown escalating trade war, there is absolutely no guarantee that the U.S. government will grant this historical exemption. The threat is very real, and the consequence if that exemption fails is catastrophic.
And management's only real mitigation, besides hoping to restart Jarrett Canyon, is their cash pile to just absorb the pain.
That's right. And the second risk, that SAT tax dispute, is also still very much in play. The potential liability is huge, over $200 million. They're fighting it, but it creates this constant negative news flow and legal costs.
So the confluence of these risks, the binary tariff threat, and the lingering tax liability, it just means that being 100% concentrated in Mexico is the worst possible positioning for the 2025 geopolitical environment.
It is the ultimate headwind. They are generating record profits in the face of unstoppable macro demand, but their geographical location makes them acutely vulnerable to political decisions completely outside of their control. And that is the core tension of this stock.
Chapter 7. Conclusion. All right, it's time to put all this together. Let's start with the definitive bull case for First Majestic Silver.
The bull case rests entirely on leverage and execution. They have successfully pulled off the Gatos acquisition, achieving record output. They have the financial security, that $568 million cash fortress to weather shocks, and they are the ultimate lottery ticket stock.
Explain that.
If that structural solar deficit pushes silver to $50 or even $100, their operating leverage means their earnings per share could jump to $1 or $1.50 up almost overnight, instantly justifying that current PE ratio.
Okay. Now, the bear case, which is grounded in that geopolitical reality.
The bear case is powerful. The stock is extremely overvalued at 90 times PE, offering zero margin of safety. Their 100% operational concentration in Mexico is the worst possible positioning in this trade environment, leaving them totally exposed to that existential tariff threat. And their high AISC of $21 an ounce means they just don't have much resiliency if silver corrects back down to $25.
So let's finalize the valuation verdict. Our DCF model, assuming a long-term price of $35 an ounce and that they dodge the tariff bullet, put the intrinsic value between $13.50 and $16 per share. The current price is right in the middle, at $15.23.
The stock is perfectly situated. It's fairly valued relative to its long-term potential, but severely overvalued relative to its current trailing earnings. They've executed the growth strategy flawlessly, but the market has already factored all of that operational upside in.
So what's the final action for an investor looking at the stock today?
Our verdict is that AG is a high-octane hold. It is not a fundamentally safe value buy. It's only appropriate for investors who have a strong, unwavering conviction that silver is going to $100 and who are willing to accept the extreme volatility and geopolitical risk that comes with it.
And if your priority is margin of safety.
If margin of safety is your priority, you have to look elsewhere, maybe toward Hecla mining for that jurisdictional insulation.
And that brings us to our final provocative thought for you to consider. The decision to hold or buy First Majestic Silver really boils down to one single question, one race. Will geopolitical reality, the threat of that 25% U.S. tariff, overshadow the unstoppable macro demand from the global solar revolution?
It's a race between politics and supply-demand fundamentals, and the slightest political misstep could mean the fundamentals just don't matter.
Thank you for joining us for this deep dive into the paradox of First Majestic Silver Corp.
We hope we've given you the nuanced, detailed insights you need to navigate this very high-risk, high-reward investment thesis.
Don't forget to like and subscribe to Stock Analytics AI.
And if you want to accelerate your knowledge and get ahead of the market moves, for €4.99, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Finally, a clear statement that this analysis was generated by an AI system based on public data for educational purposes only and should not, under any circumstances, be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.